What is happening in markets right now is the kind of environment that punishes people who think in headlines and rewards people who think in systems a few hours ago. The Federal Reserve made it clear that rate cuts are no longer something investors can simply assume are coming soon. That matters. But not because one meeting changes the world by itself. It matters because it shows where we are in the cycle. We are in a strange phase. Asset prices are rising, stocks are near all-time highs. Bitcoin has started moving again. Housing is weak in some places and firm in others. Consumers feel terrible, investors feel excited, and at the center of all of it is the same force that has shaped economic history again and again: inflation. People often think inflation is just higher grocery bills, higher gas prices, or a more expensive mortgage. That is too narrow. Inflation is a system-wide force. It changes the behavior of central banks. It changes the cost of money. It changes how investors discount the future. It changes the psychology of consumers. It changes who wins and who loses. And right now, the most important thing to understand is that the Fed is trapped between two difficult realities. If it cuts rates too quickly, inflation can reaccelerate. If it keeps rates high for too long, the economy can weaken. That is the kind of situation where people who rely on simple predictions get hurt. The market does not move because one variable changes. It moves because many variables interact at the same time. Oil prices, interest rates, wages, debt, consumer sentiment, earnings expectations, housing affordability, liquidity, and political pressure all feed into one another. That is why I do not look at this moment as a clean bullish or bearish signal. I look at it as a late cycle high. Liquidity, high uncertainty environment where asset prices can melt upward even while the real economy feels worse for ordinary people. That may sound contradictory, but it is not. It is actually how cycles often work near their most dangerous points. When oil rises, the cost structure of the economy changes quickly. Oil is not just gasoline. Oil is transportation. Oil is shipping. Oil is plastics. Oil is fertilizers. Oil is machinery. Oil is the cost embedded inside nearly every physical good that moves from one place to another. When crude rises meaningfully, it does not stay in the energy market. It travels through the supply chain. It reaches the trucker. It reaches the factory. It reaches the airline. It reaches the farmer. It reaches the packaging company. Eventually, it reaches the consumer. That is the mechanism. And when that mechanism is working, the Fed cannot simply declare victory over inflation and start cutting rates because investors want it to. A rise in oil can push headline inflation higher. It can also reduce growth because consumers have less money left after paying for energy and basic goods. That combination is uncomfortable because it creates pressure from both sides. Inflation pressures the Fed not to ease. Weak growth pressures the Fed to ease. When both happen together, the central bank has to make a trade-off. And the quality of that trade-off depends on credibility, timing, and the structure of the debt system. That is why the market's expectation for rate cuts has shifted so sharply. Investors who were previously expecting relief have had to reprice the probability that rates remain elevated for longer. But here is the strange part. Even as rate cuts get pushed out, asset prices are rising. That is the part many people cannot reconcile. They think higher rates should automatically mean lower stocks. Sometimes that is true. But markets are not mechanical in that simple way. Markets are discounting machines. They do not only look at today, S-pain. They try to look through today, S-pain into tomorrow, S-earnings, tomorrow, S-liquidity, tomorrow, S-policy response, and tomorrow, S-risk appetite. And in this moment, Wall Street is betting on tomorrow while Main Street is living through today. That difference explains almost everything. The stock market has rallied with incredible speed. It went from oversold to overbought in a very short period of time. The Nasdaq has shown extraordinary strength. Risk assets have moved as if investors suddenly decided the worst case was no longer the base case. At the same time, consumer sentiment is extremely weak. That sounds irrational until you understand that stocks and consumers are measuring different things. The stock market is asking, what will earnings, liquidity, policy, and capital flows look like in the future? The consumer is asking, what does my grocery bill cost today? What does gasoline cost today? How secure is my job today? Can I afford a home today? Can I save money today? Those are not the same questions. And because they are not the same questions, it is possible for the market to melt up while ordinary people feel like the economy is broken. That is not a moral statement. It is a structural observation. Assets respond to liquidity, earnings, and expectations. Households respond to wages, prices, debt payments, and security. When the ownership of assets is concentrated, a rising market can make the wealthy feel wealthier even while the median household feels squeezed. That is one reason these environments become emotionally confusing. People look at the market and see strength. They look at their own life and feel pressure. Both can be true. This is why I have learned not to build my investing process around how I feel. Feelings are usually late. When the market feels safe, prices often already reflect too much optimism. When the market feels terrifying, prices often already reflect too much pessimism. That does not mean every decline is a buying opportunity or every rally is a bubble. It means you need a process that survives your emotions because your emotions are usually responding to what just happened, not what is likely to happen over a full cycle. In a market like this, the biggest mistake is to think you can wait for perfect clarity. Perfect clarity usually arrives after the price has already moved. The people who sold at the bottom to wait for certainty missed one of the fastest rallies in history. They did what felt reasonable. They looked at inflation, oil, political uncertainty, weak sentiment, and they said, "I will wait." Then the market moved without them. This happens again and again. In investing, the price of comfort is often lower returns. If you want to buy only when the world feels safe, you will usually pay a much higher price. If you want to sell every time the world feels dangerous, you will often sell into other people's fear. The right question is not, do I feel comfortable? The right question is, what does my system tell me to do when the world feels uncomfortable? That distinction matters. Because right now the market is entering what some people call a melt-up. A melt-up happens when asset prices rise quickly because investors become afraid of being left behind. It can be driven by liquidity, it can be driven by momentum, it can be driven by earnings optimism. It can also be driven by the belief that policymakers will not allow a severe collapse. A melt-up can make people feel rich very quickly, but it can also be dangerous because the same psychology that drives prices higher can disconnect people from risk. That is why I try to separate two questions. Can asset prices keep going higher? Yes, they can. Does that mean risk has disappeared? No, it does not. The danger is when people confuse rising prices with falling risk. In reality, when prices rise faster than fundamentals, risk can actually be increasing, even as people feel better. That is the paradox. Markets can become more dangerous as they feel easier. This is also why I do not try to call tops and bottoms based on one news event. A Fed meeting, an oil spike, a rate forecast, or a political transition can matter, but none of them is the entire machine. The machine is the interaction among debt, money, growth, inflation, policy, and psychology. If you understand that, you become less reactive. You stop saying, the Fed did not cut, so stocks must fall. You stop saying oil is up, so everything must crash. You stop saying sentiment is terrible, so markets cannot rally. You look instead at the full cycle. You ask where liquidity is going. You ask whether earnings expectations are improving or deteriorating. You ask whether credit is tightening or loosening. You ask whether consumers are under pressure. You ask whether policy is becoming more supportive or more restrictive. You ask whether asset prices are discounting, disaster, or perfection. Then you build a portfolio that can live through multiple outcomes. That is more useful than trying to be clever for 1 week. Bitcoin is a good example of this emotional cycle. When Bitcoin falls sharply, many people say it is finished. They say the institutional story was fake. They say the ETFs did not matter. They say the asset has no future. And then when it rises again, the same people start asking whether it can go to impossible numbers. The asset did not become completely worthless at the bottom or completely risk-free during the rally. The emotion changed. That is why position sizing matters. If an asset is volatile, you do not need to be all in or all out. You can hold an allocation that fits your risk tolerance and your overall portfolio. That way, if it falls 30%, you do not panic. If it rises 30%, you participate. You do not let the asset control your psychology. For some investors, Bitcoin is a hedge against monetary disorder. For others, it is speculation. For some, it is too volatile to own. The right answer depends on the person, the time horizon, the balance sheet, and the size of the position. What I would not do is make my decision based on the crowd's emotional temperature. When everyone is certain it is going to zero, that is usually fear speaking. When everyone is certain it is going to $1 million immediately, that is usually greed speaking. Neither fear nor greed is a strategy. Housing is another place where people need to think in systems rather than headlines. National numbers can hide very different local realities. One market can be weak because prices ran too far ahead of incomes. Another can be stable because supply is tight. Another can rise because it remains relatively affordable compared with coastal markets. So when people say housing is going up or housing is going down, they are often speaking too broadly. A house is not the stock market. It is local. It is financed with debt. It is affected by mortgage rates, wages, inventory, migration, taxes, insurance, and psychology. Right now, the key variable is mortgage rates. Higher oil can feed inflation expectations. Higher inflation expectations can keep bond yields elevated. Higher bond yields keep mortgage rates higher. Higher mortgage rates reduce affordability. Reduced affordability weakens demand. Weak demand forces sellers in some regions to cut prices or negotiate more aggressively. That is the chain. And that chain is why housing can be flat nationally while some markets decline and others rise. If a market had an extreme run-up from 2021 to 2023, and if inventory is now rising, and if affordability is stretched, prices can soften even while the national average looks stable. That is not a contradiction, it is local market dispersion. For buyers, this creates a different environment than the frenzy of the last cycle. There may be less urgency, there may be more inventory, there may be more negotiation, but lower prices do not automatically mean affordability is good if mortgage rates are still high. That is another important distinction. A house can be cheaper and still not be affordable. A payment is not only the price, it is the price, the rate, the taxes, the insurance, the maintenance, and the income supporting it. If rates decline modestly over the next several years, that can help, but it may not be enough to restore the affordability that existed when rates were extremely low. Many people are waiting for mortgage rates to fix the problem. That may be too optimistic. The bigger lesson is that housing, like stocks, is not something you should approach with a single prediction. You need to know your own cash flow, time horizon, job security, and local market. If you buy a house because you expect immediate appreciation, you are speculating. If you buy because the payment is durable and the house fits your long-term life, the risk is different. Again, the system matters. Now, the Fed transition adds another layer of uncertainty. Jerome Powell's term ending and a new Fed chair potentially taking over changes. The psychology around policy investors immediately start trying to predict whether the next chair will be more dovish, more hawkish, more political, or more independent that can move markets. But it can also mislead people. A Fed chair has influence. But a Fed chair does not control everything. Inflation data matters, labor markets matter, bond markets matter, political pressure matters. The rest of the Federal Open Market Committee matters, global capital flows matter. The idea that one person can walk into the Fed and force the entire economy into a straight line is too simplistic. Still, leadership changes matter because they can alter the reaction function. If the next chair is more willing to tolerate inflation, the market will notice. If the next chair is more focused on shrinking the balance sheet, the market will notice. If the next chair tries to prove independence by keeping policy tight, the market will notice. This is why transitions can produce volatility, not because the future is known, but because the market has to reprice probabilities. Historically, new Fed chairs often face difficult markets early in their tenure. That does not mean a crash is guaranteed. It means uncertainty rises when investors have to learn how a new policy leader reacts under pressure, and markets hate not knowing the reaction function. So what should an ordinary investor do with all of this? I come back to a principle that is simple but hard to live by. You need an allocation that you can hold through a 30 to 50% drawdown without destroying yourself emotionally or financially. Most people say they are long-term investors. Then the market falls 20% and they become short-term traders. That is not because they are bad people. It is because they had the wrong allocation for their real risk tolerance. If your portfolio is too aggressive, the market will eventually force you to sell at the worst time. If your portfolio is too conservative, inflation and miscompounding can quietly erode your future. The right allocation is not the one that looks best in a spreadsheet. It is the one you can actually stick with when the world is ugly. That is why consistency matters so much. When you invest the same amount regularly, you reduce the need to make heroic timing decisions. You buy when prices are high, you buy when prices are low, you buy when the headlines are terrifying, you buy when the headlines are euphoric. Over time, your system absorbs volatility instead of being destroyed by it. This is not exciting, it is not viral, it does not make you feel like you have secret information. But it works because it aligns with how markets compound over long periods. The people who did this years ago, even when markets were at all-time highs and everyone was warning about a bubble, were rewarded. Not because every month was easy, not because there were no crashes. They were rewarded because they stayed in the game. Staying in the game is the first rule. A portfolio that survives is better than a portfolio that looks brilliant for 6 months and then blows up. That is why I do not make big decisions because oil moved, because the Fed paused, because Bitcoin rallied, because housing softened, or because consumer sentiment collapsed. I notice those things, I respect them, I incorporate them into the picture, but I do not let any single data point hijack the process. What I want is a balanced system that can handle different environments, equities for long-term productivity and ownership of earnings. Some cash for liquidity and optionality, but not so much that inflation quietly dominates me, some exposure to assets that can benefit from monetary disorder if that fits the investor. Risk profile: real estate only when the numbers and the time horizon make sense. Debt used carefully because leverage can be powerful when the cycle helps you and brutal when the cycle turns against you. That is the way I think about it, not as a prediction contest, but as a risk management exercise. The great mistake most people make is that they want certainty before they act. But markets do not give certainty. They give probabilities, they give cycles, they give incomplete information, they give emotional stress. Your job is not to eliminate uncertainty. Your job is to build a system that functions inside uncertainty. That is what the current environment is teaching us. The Fed can cancel rate cuts and the market can still rally. Oil can rise and risk assets can still melt up. Consumers can feel terrible and Wall Street can feel optimistic. Housing can be flat nationally while local markets diverge. Bitcoin can fall 30% and then rise quickly. A new Fed chair can change probabilities without giving you a clean answer. If you need all of that to make sense emotionally before you invest, you will usually be late. If you understand that these contradictions are part of the machine, you can act more calmly, and calmness is one of the greatest advantages in investing. The person who remains calm does not need to know every short-term outcome. He needs to know his principles. He needs to know his allocation. He needs to know his time horizon. He needs to know what would make him wrong. He needs to know how much loss he can withstand. He needs to know what he will do if markets fall, what he will do if markets rise, and what he will do if nothing happens for a long time. Most investors do not have those answers before the stress comes, so they improvise under pressure. Improvisation under pressure is how good people make bad financial decisions. This is why I always come back to process. Decide how much you can invest each month. Decide what allocation you can live with. Decide how much volatility you can actually tolerate. Decide how much liquidity you need. Decide what role each asset plays in your life. Then execute, not perfectly, not emotionally. Not because someone on television said the Fed will cut. Not because someone on the internet said Bitcoin is going to zero. Not because housing in one city is falling. Not because one oil spike scared you. Execute because your system was designed before the headlines tried to manipulate your nervous system. That is the difference between being a participant in the cycle and being a victim of the cycle. Right now, we are watching a market that feels unbelievable. That does not mean it must end tomorrow. It also does not mean it is safe. It means the cycle is alive, liquidity is moving. Policy uncertainty is high, and emotions are becoming more extreme. This is exactly when discipline matters most. If the melt-up continues, a disciplined investor participates without becoming reckless. If the market reverses, a disciplined investor has liquidity, diversification, and the emotional ability to keep buying if inflation stays high. A disciplined investor understands that sitting in cash forever is not safety. If rates remain elevated, a disciplined investor understands that some assets will struggle and some will adapt. The world does not owe us a simple environment. It rarely gives us one. But if you learn to think in systems, you can see through the noise. You can understand why the Fed is cautious, why oil matters, why sentiment and stocks can diverge, why Bitcoin and housing behave differently, and why the best answer is usually not panic or euphoria. It is a durable plan. So here is where I land. Do not assume rate cuts will save you. Do not assume the market must crash because the data looks messy. Do not assume a rally means the risks are gone. Do not assume you can wait for perfect clarity. And do not let 1 week of market action convince you that your long-term plan should be rewritten. The strongest investors I have known are not the ones who predict every turn. They are the ones who understand that cycles turn, surprises happen, and compounding requires staying power. That is the real lesson of this moment. The market can melt up, inflation can come back, the Fed can stay restrictive, Bitcoin can rally, housing can soften, consumers can suffer, Wall Street can celebrate. All of those things can be true at once. Your job is not to be shocked by complexity. Your job is to build a life and a portfolio that can handle it. Because over long periods of time, the people who win are not the people who had the loudest predictions. They are the people who had the best principles, the clearest process, and the discipline to keep going. When everyone else was being whipped around by the news of the day,